we go.
Hold up right there. I'll introduce you in a minute, Mr. Wong. Do you want to build wealth, but your credit is in the toilet and you're a DIYer? You need to listen to this episode. Happy Friday. This is Kat's Home Chat Live. And with me is the man, the myth, the legend, Mr. Wong. Say hi, Mr. Wong.
Good morning, America. How's everybody
doing? We
doing?
love you, America.
Good morning, Patrizia, over in Italy as well. I know you'll come up.
Yes, in Italy. Hello, Patrizia. I know you're on. So we're going to spend about 25, 30 minutes, and we're going to share with you what I personally have done myself, not hiring a credit repair, which that's okay. I know we'll probably have a credit repair company on as a guest in the future. But for those of you who don't know me, I've been in all things real estate, home, decorating, staging, color for about 25, 30, I don't know, a bazillion years. I know I look really good for 90. So I know a little bit, and I am a DIYer. So when Jeff and I came here about, I see your hand, Jeff, 19, 20 some years ago, our credit was pretty much in the toilet. Okay. So we proceeded to seek out how we could improve our credit score. And I'm going to go beyond what the obvious, things are to do. And of course, number one is pay your bills on time. Okay.
Yes.
Right? Would you agree with that? Don't have derogatories. If you have derogs, what they call derogs on there, they're going to have to season a little bit, which means once they're aged, your credit score will improve. But I'm going to share with you some tricks that you can do to increase your score rather quickly. Okay. And depending on how our credit was pretty much in the toilet for some tax liens and other things that we had to pay off and so forth and have them season. Your credit may not be that bad. You could bump up your credit 30 points or so in a very short time. We needed a little bit more bump up. So I'm going to give you 3 things, and the last one is critical, and a lot of folks don't know about this. I was just actually advising one of my team members who we want to get her in a new home, and shared this information with her, and she's having success already. So first thing is, whatever your credit limits are, get them down 50%. And Jeff, I know you helped us work on this, going through all the credit cards. If let's say you have a small card and they are giving you $3,000 limit, you want to get that down to that magical, $1,499 or less. That will bump up your score tremendously. On that note, the second thing that you can do, and Jeff and I have done this as well, is contact those debtors, credit card companies, and ask them to increase your limit. So you can pay it off and or increase the limit, or do both. That's going to help. Right, Mr. Wong?
Yes.
Just like Ed McMahon today. Thank you, sir.
Yes.
So put down the credit cards, increase the limit are 2 huge things that you can do. But the last one I'm going to share with you, this is going to take some effort, but it's not sweat effort. It's really just writing some letters. And I learned this many years ago, again, being a DIYer, wanting to improve my credit myself and not hire a company. You want to dispute. Okay. And at the end of this program, I'm going to give you the contact for the 3 credit reporting agencies, TransUnion, Equifax, and Experian. All of their websites are just the name, transunion.com, Equifax.com, Experian.com. You can request, and if you didn't know it, you are entitled as a consumer to one free credit report a year. So that's the first thing that you want to do is you want to see where you're at. Okay. You can't make a plan. You can't go somewhere till you have a map, or in our case, a GPS, and know what is my destination? How do I get there? So you need to know on there, excuse me, because there may be things on there that you have no idea or incorrect information. So you want to get that report and go through every single thing that is on there. Make sure the balances are correct. The debt is correct. And then what you want to do is dispute either, I know I just copied a sheet of paper dispute letter and wrote a dispute for every single thing. And here's the key, guys. Whether it's your debt or not, dispute it. And let me tell you why this works. Because if it's an old debt, chances are they've sent it to a collection company and then they've tried to get it and then they've archived it. Okay. Now I'm not purporting, buy stuff and then, try to get out of it. But if you've got old debt there, and, I helped a gal many years ago who's now a very good friend. Her credit was in the toilet. She had an ex-boyfriend who helped her get it in the toilet. And what we did is, which is what I'm going to do with my team member, is we got her credit up to just a minimal increase and then put her in credit repair. In this case, we're giving you the DIY credit repair, and we built her a home. Took 3 to 4 months. By the time the home was built, her credit was stellar. Everything was good. So most of your builders today, they have a benchmark. So you'll want to be at a certain amount. And if you need that information, you can private message me. But that is a great way. Don't wait. Interest rates are how low now, Jeff? Are interest rates?
The interest rates are at all-time low at this point, but it varies. The key thing that you want to know that there are tools that's probably available to you right now. Like, for instance, your FICO score could be obtained with your bank account, or some of your credit cards actually offers you these reports on a monthly basis so you can track it.
Yes. So that's a very good point. Now, that coupled with, don't confuse that with a full credit report, because they will not give you a full credit report. And I know there's many companies out there, they've been soliciting us that, get your, even Experian and all of them do it, get your free credit report, value, credit repair, and so forth, which may or may not be in your best interest. Again, if your credit is in the toilet or you need quite a bit of help, like ours was, you may want to do some of that initial work yourself. And I can't stress enough over dispute. So back to the aging or old debt, you particularly want to dispute those, because here's the logistics behind it. Once they've opted to, say, a collection company, after so long, then they age it and they don't have access to those reports. So when you dispute it, these TransUnion, Equifax, Experian, they have 30 days. There's a case number applied. They have 30 days to defend it. And so the onus is on them. They have to come up with proof that you owe it. And chances are, again, because it's aged, they do not have that readily available. It's easier for them just to dismiss it. What happens when they dismiss it? Your credit score goes up. Now, how quickly does it go up? Depending on where your credit is, typically it's every 30 days they'll do a rescore, and it's usually a certain day of the month. So you want to have a concentrated effort in writing those dispute letters, so that your credit score when they do a rescore. Now, once you get into, let's say, a builder credit repair program, they have access to a service called Rapid Rescore. So, you're really in good hands when you're, in a builder credit repair, because they have that service, and they can guide you in some of the things that I'm advising you to do as a DIY. And instead of waiting 30 days, they can rapid rescore it in a very short time. And that's going to bump your score up. And yes. I know you come from the builder world as well. Jeff, have you experienced the credit repair with the builders?
Yeah, as a matter of fact, that's one of the advantages about working with new home builders for many years. And some of your top major home builders have their in-house financing with credit repair departments. Their philosophy and their idea is that they're going to be able to build your home from the ground up, and during that time, they are assisting you and giving you directions and instructions on how to pave your way to the path of high credit score to get that loan for you. And of course, the better the credit, the better everything for this type of financing.
Yes. And of course, the stellar rates we're talking about right now. Let's talk about that a little bit, about, what is good credit and what can you expect. So high sixes, I would say mid sixes, 600s, that is, in FICO, that can get you started on a credit repair. That's poor to fair. Okay. Now, FHA, I don't know the current FHA. I want to say it's around 680. So
580 or higher gets you 3.5%
today?
down payment today for 2020.
Okay.
Well, lower than 580 is 10% down payment.
Wow.
Yep. So that's your FHA program for 2020.
Okay. And of course, that, let's talk about interest rates. Back when I purchased my first home in the 80s, I paid 13% interest. And why? Yep. Because I only put 5% down. So, interest rates have just been historically low. Even when they're in this 5-6%, it's historically low. But who doesn't want to take advantage of, either refinancing and or purchasing your first home? And, I started out this program saying, do you want to build wealth? And suffice it to say that purchasing real estate, and I'm not talking commercial and builders and this and that, but just for consumers, is the best way to create wealth in your portfolio. It's called equity. And, Jeff and I come from Southern California. We purchased a home, 20 years ago, and within 2 years, it went up 200,000. In Texas, you're not going to experience that kind of increase in equity. But we're very fortunate here in Texas that the market is steady. It's steady, and you will build equity, just not exponentially. To the same degree, California does this, and it also has done that. I think the home we sold went up another 200,000, and then it took a dive. So very radical. But if you want, steady, and to build wealth, because after all, like last week's program, there absolutely is no place like home and a place to call your own home. You'll want to take some of these steps to build your credit. So did you mention two? So with good credit on a conventional, we're looking at, what is the current rate?
We're looking at FHA, and this is the most affordable way for most FHA? Working class families to be able to obtain their mortgage loan, unless you have a buttload of cash sitting in the bank, And this is something you have to consider in regards to that the size of the home you're buying, because FHA doesn't roll into a big jumbo loan of 400,000 and up thing. So we're looking to help most of your working class family when you're looking at the level of the credit score, and this is the hardest part for everybody to grasp, is that when you're living your daily lives and you're starting to use your credit power to purchase everything to go in your house, whether it's your TV, whether it's your cars and so forth, all those things adds up and lowers the credit score. So therefore, the banking industry then looks at that and saying, well, since you're a risk having a lower score, we can feel better about loaning you money if you pay us interest a little bit more higher because we're loaning you money. Now, of course, this is something that is it's one or the other. It's one of those things that if you do it and you're like, well, gee, I'm just giving bank my money. Well, then if you don't, then the other aspect of it is, well, if I don't own a home, I don't have that investment of that equity you talked about.
Absolutely. Well, go ahead. I didn't mean to interrupt you.
What I was going to say is that real estate doesn't go away. Unlike if you look at your gold, silver prices, where it fluctuates in the last several months, up and down, that's a little different. Anything else you invest in, like, we know for 20 years ago, .com blown up, fell apart. There's all kind of things that is more volatile than today. Cryptocurrency, is that going to work in the long haul? We shall see. Right now, we're going through a really strange, difficult time with the so-called the economy, with the way that COVID has changed the world, and as well as the election in the United States. So the thing that is ultimately will happen is the smoke will clear, the cloud will part, the sun will shine, and we'll go back to norm. But the norm may be different structures and different agendas and different guidelines. But one thing we can be sure of is that piece of land and that house that you now have under your name and title and you own is not going away. And that's why it's a solid investment. And that's why you want to take the initiative, repair your credit. One of the things is that don't keep on spending on things that you don't need to spend on. For instance, buying daily Starbucks at $5 a pot. I've told this to many homeowners that's sitting there going, I don't know if I can save my 3.5%, or even worse, I don't know how I can come up with 10%. Well, 10% for a hardship of the first 6 months that you're doing your credit repair while you're getting your house built is 30 years on of now building equity. So you have to think in the big picture and then bring the discipline to yourself to say, I'm going to sock away, and my goal is 3.5% for this. So what are we going to cut the fat around? Eating out, going to places, or buying Netflix movies, or whatever the thing may be that's eating up your excessive cash that you could save. That is the strategy that you want to have. In credit score itself, there's credit repair. I'm not going to say that everybody's created the same, just like the real estate industry, just like everybody else. Some credit repairs are fantastic. Some are not. So how do you get one that is? Well, you ask reputable real estate professionals for recommendations.
Absolutely.
And then you ask credit repair for evidence. Show me your success stories. Don't ever be afraid to ask question after questions about your future and your finances. This is not something that you should ever feel intimidated about. This is something that you always want to acquire knowledge, because it helps you, your family, and then it goes on generational from that point.
Absolutely.
Hello.
Absolutely. Great points, Mr. Wong Nader. The myth, the legend, the myth. No,
It's
the man.
better to be wrong, right?
I forgot his name, so I had to get him a hat that had his name on it.
Well, I was forced to wear this hat at my work. COVID has obviously, in some respect, gave us a lot of weird guidelines in my company. So also, we have to wear hats that bear our name, because I guess it's hard to see and identify who we are when we have a mask.
There you go. That's it. So, Jeff, I want to talk about a couple of things that you made me think about while you were sharing. And that is, first off, lenders look at what they call DTR, debt to income ratio. Okay. So that's something that you want to be cognizant of, because you might say, oh yeah, I make I make 100,000 or I make 150, whatever it is, 80,000. But if your debt to income ratio, just kind of think of the number, like 46 to 50%, you want to have a debt to income ratio, because I've run across in my career a couple of things. Number one, the self-employed. So if you're looking to get credit, if you're looking to buy a home, I had a trucker years ago, owned a trucking company, and I was doing build on your lot at that time. And he wanted us to build him a home. And unfortunately, he made great money, but he wrote everything off. So according to the underwriters, he didn't make enough to qualify for a home, even though he made really good money. So just a little tip there is, you might want to consider paying yourself. Okay, if you're looking to purchase a home, it's actually easier to buy a car than it is a home. But in that case, yeah, pay yourself an income, okay, so that you can show that as income that can be credited towards your debt to income ratio. Unfortunately, I had to tell him, I'm sorry. He was bragging how he wrote everything off. And,
Yep.
I know a lot of businesses, there are a lot of write-offs, but you want to be strategic about that if you are looking to purchase a home.
Yep.
The second thing did you have something on that, Jeff? You wanted to?
Well, I was just going to say, for everyone who's interested in credit repair and understand debt to income ratio, this is a huge key factor that you need to be aware of. And then it basically allows you to understand what you have to work with and then where you need to go. I just Googled immediately DTI, and Wells Fargo comes up with a debt to income ratio calculator that you can access. It is very simple. Now I'll give you an example of what I did. I make 50,000 a year. Okay. And this is typical. Believe it or not, a lot of families with two incomes are making no more than 50 grand a year. That's tough. But you know what? Save your money and buy a home. So let's say this. It says add your monthly debts, including your expenses, but don't include the living expenses. So I just kind of hypothetically threw in 1850, because rent and whatnot to get that. And you can hit the button that says calculate my DTI ratio. And for $50,000 a year annual salary at my 1850 monthly expense, it shows me that I'm at 44% opportunity here, 44% debt to income ratio. And of course, that's the opportunity to improve, because 44%, that literally means that if I'm sitting in front of a mortgage officer and lender and they're asking me the DTI and they factor this in, that means almost 50%, half of my income is going to go into paying the house. And no mortgage company is going to feel safe about that.
Well, I think, just to interject here, I believe FHA, which is more lenient government loan, I believe they'll go up to either 46 or 50. I think 40. It's the high 40s for FHA. But one thing I want to add to this, when people are figuring out, that's your gross income, folks, especially you first-time home buyers. That's not your net income. So that's gross. That's from if you have multiple jobs. In addition, if you are receiving child support, Social Security, any kind of monies besides coming from a job, that is grossed up, which means they add 25% to it. So, example, if it was $1,000, it would be $1,250. Is that right? It'd be $1,250. So it's padded by 25%. Any kind of monies that you have coming in that are not directly, taxed is going to be grossed up. So that's helpful to know when you're figuring out that debt to income ratio.
Well, here's your debt to income ratio currently for FHA coming out of last year to this year is at 31% for housing related. In other words, your rents, your things of that nature, but 43% for your total debt. So like the calculation that I just did on that example being 44%, most likely that we're going to have to sit down with a mortgage lender, and they're going to have to sharpen their pencils and then assist you to lower that down a couple of points, because
Right.
that couple of points really means either you're getting a loan or you're not.
Makes a difference. And that's all your credit cards. So sometimes just paying off one credit card or, and let's talk about credit cards briefly on this short time. And that is, here's a mistake that actually Jeff and I both made. I think I made it first thinking, no, you never made a mistake. Oh, I'm sorry. Only me. That's right. The legend, the man, the myth, the legend. I was so excited when I was proactively writing these dispute letters for all of this old debt and seeing my score go up and up. And so I was very excited to get things closed down and paid for and, cleaned up, I thought. So the mistake you don't want to make is don't close the credit card.
That's correct.
You go, okay,
Never
I'm done
close
with
it.
this, this Ann Taylor card, I never use it, whatever, and you close it.
Yeah.
Don't close it, okay? Because the bottom, you can get it down to as low as you want, 30% or whatever, but keep it open. I know it's more to manage, but it will improve your credit score, because this is what the underwriters look for, or actually the reporters, is how much credit are you given and how much are you using? So let's just say Ann Taylor is letting you card for $1,000 and you never purchase there anymore and you want to close it. Well, that's $1,000 now that you don't have in your portfolio. So it's all about how much credit you have, but how little you use. If you take anything away from
It's
credit
management. It's
What's
all
that?
about credit management. It's
Yeah.
the same thing that, many retail stores will offer, financing. And one of the marketing tools that they use to market their in-house financing is they say, we will help you repair your credit if you buy this refrigerator from us and use our finance plan, and then we'll do the FICO reportings for these three entities, and then we'll raise your credit score. Now, while
does that work? Does that work?
It does work. However, you have to follow up with it. You cannot just listen to that pitch by a salesperson in the retail store and expect that it's just going to go along smoothly. You need to monitor it, because I have seen across the board that some company do it really well for you, and some company uses it as a pitch to sell you a product and never do it. Okay.
And it's
So
all
be aware
the
of it.
more. I was just going to say, it's all the more. I encourage you. I'm not poo-pooing credit repairs, but there's so much, guys, that you can do on a do-it-yourself basis. I know I raised our score, about 230 points. Okay. Now, did that happen overnight? No, that took. Because we had some huge tax debts, tax liens, different things, and then a lot of disputing. So it took about 9 months, close to a year. But most of you won't have that huge of an issue, and you can bring your score up 40, 50 points in a relatively short time if you just go through the checklist, of increasing limit, paying down to 50%, dispute those old debts. That will help you immensely.
Yeah.
Did I miss anything here?
No, and that's a key factor. You need, for everybody who's involved, thinking that, hey, you know what? I want to buy a house. My credit isn't so good. Don't give up. The thing is about making this a successful journey is you have to take responsibility for monitoring and discipline and follow-ups. This is key, crucial.
I love that, Jeff.
Yeah. And here, let me just bring this point to that. This is not an overnight thing, but it is definitely less than a year thing. Okay.
Definitely less than a year.
Yeah. And then the financial consultants that I've worked with and I've done studies with and so forth, all tell you this. Number one thing you need to do when you get your paycheck, pay yourself in a savings and sock it away. You need to come up with a percentage, like 15%, and sock it away. Then the other remaining 85 is how you operate them. Okay. And you're going to say, well, how am I going to do that? I make $2,000 a week and I'm spending about $1,950. And that's a $50 left. That's a walking around money in my pocket. So how can I do that? Well, if you look at breaking down your system and really understand what that $1,950 is going to. Oh, there's an ongoing $35 to the gym. How often do you go to gym? Oh, I haven't been there in a month. Really? So I have.
No, we're not advocating don't go to the gym.
No, I'm talking about.
I think what Jeff is advocating is that, look at your situation and see where the fat is, because it's easy for us to just pile up things and pay yourself first. Now, I'm not going to advocate to save before you've paid off these high interest credit cards or paid them down, okay? Because you got to be strategic and pay them down. So, excuse me. Because where's my lemon tea? But let's say FHA, 3.5% down. So the bottom line is, first, see where you're at. Get a copy of your credit report.
That's right.
TransUnion, 800-916-8800. Equifax, 800-685-1111, and Experian, 888-397-3742. If you don't want to call them, just .com them, transunion.com, equifax.com, experian.com. You are entitled to a full credit report with every single detail that's been reported once a year at no charge. So you want to find out where you're at first. That's critical. And then come up with a plan. So as Mr. Wonganator mentioned, you have to put in the effort. You have to put in the time. And speaking of time starts now. So do it now. Take action. Because you know what? What we do today creates our tomorrow. And if you just sit back on your laurels and go, yeah, well, I don't know, I got bad credit and yada, 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 you don't take action, you're going to be the same, you're going to be paying for someone else's gas in their SUV renting, and I guess I'm talking to you homeowners. Everybody should be a homeowner. If you're paying $1,000 with rents, oh my gosh, I know many of you are paying $1,000 or more for rent, and that's just getting, tossed away. So I'm going to leave you with one tip. Years ago, when I was working with first-time home buyers in the new home industry, one of the things that I helped educate my first-time home buyers, particularly who were, having a little bit of sticker shock to go, I don't know if I can afford it. Okay. Here's another little trick I'm going to share with you. As a new homeowner, you can now claim tax deduction for all of the interest paid on your mortgage payment. So let's say your mortgage payment with everything, principal, interest, title, insurance, is $1,200 a month. I would say, what would you say, Jeff, in the beginning, first 10 years, $1,100 is interest?
There's quite a bit. It's always front loaded. You always know
Yes.
that. And here's the key factor too, is that you can get it right from the get-go when you get a loan, a payoff chart, and it'll give you
Yes.
whether you have a 15 or a
And
30.
they have websites for that too, to say if I pay off
Absolutely.
early, how much interest will I save? But what I'm getting at is, you as a first-time homeowner with sticker shock can give yourself a pay raise immediately to help compensate for, let's say, a couple $100 more a month for a mortgage payment while you're building equity. How can you do that? You go into HR and you let them know that you want to change your tax deductions.
Mhm.
So it's a misnomer to think, most people think, well, I claim, 2 dependents and myself, and that's your deductions. That does not have to be. What that is on withholding is it's an estimate of your tax liability. So now you are a homeowner. and again, I personally did this as a single mom of 3 kids, raising 3 kids, and managing and being financially creative. I discovered that I don't even know who shared this with me, but that I could go in and typically, I believe on average, when I was raising my kids, my deductions were 10 to 12. What I did is I contacted my CPA and I said, look, I own a home, I have 3 kids, here's my income. What can I project? What I want to do is I want to break even at the end of the year. I don't want a big tax check back. I want to break even. And what does this do for me? It makes it so that my house payment is going to be offsetted by the deductions. Am I explaining this right, Jeff? So
I believe so.
Yeah. So this is how I gave myself a raise. And so instead of them taking, like, let's say two or 3 deductions, let's just an example. Instead of them taking out $500 a month in tax, they only took out $250. Instant raise. I wanted the money in my paycheck every month to help ease me into new home ownership and a little bit higher than rent house payment. Okay. Again, you're not going to get that big check at the end of the year, but you're going to realize it every month in savings with more money in your paycheck, basically.
You need to educate yourself when it comes down to taxation and how to use mortgage and owning a home to your advantage. You need to do some reading, do some study, talk to professionals, because every situation is different. What Kat is talking about whether with her as a single mom or as us as a couple throughout the years, we did a lot of research. This is not something that is going to be blanket statement across. We're not making tax advisor type of.
No, we're not tax advisors. We're not credit preparers.
Real life experience.
Absolutely. We've been in new home sales and real estate for many, many, many years, but we're talking about what we've personally done in credit, what we've personally done in home ownership. And I encourage you, again, whether you're a single mom or a family, and you're afraid, to take that step into new home ownership, work on your credit first, and then talk to your CPA, accountant, what have you, to get educated on how you can strategically adjust. Because again, if you work for a big corporation or small corporation, you don't have to. You can change every month if you want to. I mean, truth be known, I used to change mine every other month because I had a base salary plus commission. So I would change it accordingly. If I thought they were not taking out enough, then I had a big commission check come and I would bring it down to 2. So I was very proactive. And as Jeff said, monitoring it so that I could strategically take advantage of the whole tax situation that would benefit me and my family best. So be proactive and take action.
Absolutely.
Take action.
Exactly that.
Jeff said, take action, be proactive, take action. It's your life. And what you do today is going to determine your tomorrow. Make it a great tomorrow. And as usual, we just want to say, stay positive, stay hopeful, stay connected. And we're so glad you connected with us today. Hope you have a fabulous, wonderful weekend. And if anybody out there would or knows someone who would like to be my guest, we're looking for home inspectors, of course, realtors always, anything to do with home, decorating, the psychology of home, broad topics. We would love to hear from you. And I think that's a wrap. Huh, Mr. Wong?
Yep. Everybody have a great week. And I just wanted to say to you, there's nothing to be fearful of things you don't understand, especially things complicated like buying a house and buying real estate. It's not as hard as you make it believe in your mind. I used to think it was difficult. Like, how could I ever learn about what escrow is? And you know what? It's like anything else. You learn one bite at a time, and then eventually you're there. You understand exactly what you're going to do. You make sound decisions.
And if you have any questions, you can message us. And just a last plug, please, 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 if you will subscribe to our YouTube channel, share this with anyone you think might need it. It will help us to, keep doing this every Friday. We enjoy it. We enjoy sharing information. If one person gets something that helped change their life, it's meaningful to us. Our channel is Tada, Tadabykat, Tada by Cat. You want to subscribe and smash the bell. That way you'll get notified with new content. We are trying to get to 100 subscribers. We're, I think, approaching 60. And with your help, we'll get there and we'll get our own unique URL. Hope you enjoyed this broadcast. And thank you so much, Mr. Wong. You were amazing, and I love you.
Ha, ha.
Bye, everybody.
Hey now.